Hey, everybody. Welcome to our 103rd week of doing this. You guys know the drill. Hit the Q&A for questions. You can harass us on the chat. And we're really excited about today. Confessions of a former IRS agent. I mean, what's not to like about that? So Adam and I put on our black shirts just, because we're not the ones sitting in the confessional booth. We're just listening and we're going to ask the questions, and you guys are going to do the same thing. So yes, we still have Jack from Shoemaker, Jack Santaniello, but we also have former IRS agent and tax attorney and business attorney, Andrew Bosserman. So all things IRS related are fair game. So hit us with questions. And you can remain anonymous in case you're afraid of, being targeted by the IRS if they listen to this. So anyway, oh yes, Jack is beautiful. Jack, you are on it, man.
I had to look at that a little bit. I thought that was actually going to be the flaming pit of hell with some devil antlers.
Well, reserve judgment. We'll see how the next 45 minutes or 50 minutes go, right?
Yeah, there you go.
So, Adam, I think you had a question you wanted to tee up. And again, please don't be silent on this thing. The only way that a confession is good is you got to ask questions. Actually, let's start with this. Andrew, give us a little bit of your background stuff. And what I would love to hear, like before we start asking some questions, because I know Adam's got a good one teed up for you. But some of the things that were enlightening during your time with the IRS and how that's helped you help clients now.
Yeah, sure. So a little bit of my background. So right out of undergrad with an accounting degree, I decided to work for the IRS as what's known as a revenue agent. But, they're the individuals who, anytime you're audited, come out and perform audits. And I was in the small business and self-employed division, which was, really any businesses up to $10 million in assets. So that's a wide variety of businesses. It's everything from sole proprietors like plumbers, electricians, barbers, all the way up to pretty large manufacturing companies. I even audited some interesting businesses like a travel agent who specialized in high-end sport fishing vacations. So I really got to see tattoo parlors also. And a lot of these things, a lot of these audits, you actually get to take a tour of the business. So that was quite interesting.
Ask a question. Did you have a gun and a badge and jump out and say federal agent?
No. So, I was on the civil side, meaning, the worst that could happen to people is that they would just owe the IRS money. But there actually are IRS criminal agents who are law enforcement. They get deputized as law enforcement, have a gun and a badge. And if they show up at your door, that's when you have a problem. And definitely call one of us immediately, because you're in much hotter water if IRS criminal investigation is looking into you. But so I got to see a wide variety of businesses, look at their books and records, learn a lot about them. And honestly, one of the things that really helped me, other than just getting exposure to a wide variety of businesses, is learning how to interact with individuals on what could be thought as, not a very pleasant experience. Most people are scared of being audited by the IRS or think that IRS agents are always confrontational, but I think it's the interpersonal skills that I learned to develop the most, developing a rapport and just showing that, this doesn't have to be confrontational. It's, we can actually work at this together and come to an agreement on the correct tax outcome that we can all agree on. And I still try to use that same kind of relationship today in my law practice.
That's awesome. So, Adam, you want to launch with your first question?
Yeah, I gotta say, Gary was gonna say it, so I guess I'm gonna be the bad guy. At Shoemaker, they clone people, so and Andrew is a clone of Jack. Sorry, the resemblance is uncanny, just a younger version in some respects. So evidently, I'm the only person that thinks that's really funny, by the way. The other
my comment back was the younger, the better version, right? So
yeah, I got you.
Yeah.
The other funny thing that I would say about the comment that came in about the red button, that she's not joking. That actually is true. I had to go into a field office in Florida, which is the first time that I got in an interview room at the IRS. And when I went in and I sat, I just went in and sat down in the chair by the door, which is actually the revenue agent's chair that has the red button, because they want to be able to escape fast and hit the red button. So the agent said, look, I feel pretty good that I can trust you, but do not hit the red button right next to your leg, because that'll send people in here. And I was like, serious? It's like, oh yeah, it happens actually more frequently.
Wow.
We'd like to say that it happens. So if you ever end up in the interview office, understand that you're not supposed to be the one by the door. That's supposed to be the agent. Oh, got it. That's funny, Rebecca. Yeah. So again, Andrew, I appreciate you being on. And based on your answer to this, I'm going to record it and then I'm going to send it to clients over and over again, because I think I know what the answer is, but I think it'd be very helpful to our audience to hear it directly from a guy who worked there, so they know that I'm not lying, unless you're contradictory, in which case I'm going to delete this whole webinar. But anyway, we get asked all the time, is that going to be a red flag? If I do that, is there 100% chance that I'm going to get audited? Followed up by am I going to go to jail for this? I think you sort of answered that by the whole civil, not criminal piece. But, can you kind of walk us through the IRS audit process and kind of touch on whatever it's called, like the sampling project versus like, we actually have issues that we're looking for type project, so that our clients and the people on the webinar can really understand, when you're selected for an audit, why did that actually happen?
Yeah, great question. This is a common misconception. I think a lot of people I've come across think that most tax return audits are random, but that's actually far from the case. So what happens is that when you file your tax return, it goes into the IRS system, whether you e-file it or paper file it, someone types it in. And then the IRS has this secret algorithm. And really, no one knows what's in this algorithm except the people that actually make it. And but a lot of what it does is compare your tax return to maybe your previous year's tax returns, and also to other similarly situated businesses or taxpayers. And then it comes up with a score. And this algorithm is known, it's called a DIF score. It pops out. I think it stands for discriminant index function, or some sort of bureaucratic term that no one understands. But if it gets a high enough score, then it gets kicked out for audit. And basically that means the IRS thinks something is wrong with your return. But it doesn't say exactly what. And after it gets, say, kicked out or flagged for audit, then it actually comes to an IRS employee, sometimes an agent, but not the eventual agent that'll work on the case. And they take a quick few-minute look at the return, and they maybe check 2 or 3 line items that look possibly suspicious, or that they think the eventual agent auditing the tax return should look into. And then once it comes from that classification where they flag the line items, then it would come to my desk, where then I look at the return. I'm required to audit those line items, but I can also expand to anything else that I want to. So in basically, most tax returns are targeted in the sense that the IRS thinks something is wrong with your return, but it's not targeted in the sense that they're coming after you, individually. Not like, I think it was about 10 years ago when I think the IRS got in trouble because they were targeting conservative nonprofits or something like that. But there are random audits, and the random audits are used by the IRS to refine that algorithm for picking returns. So when I was an IRS agent, I did a number of random audits, and then that data someone uses it to then refine the selection algorithm to be used when they're selecting most of the returns for audit. So
Yeah.
to answer your question, there might be red flags, but the thing is, no one really knows unless you're that person refining the IRS algorithm. I can tell you, there are line items from my experience that tend to be audited more frequently. So for business returns, when you're looking at expenses, oftentimes car and truck expenses and meals and entertainment expenses were always audited on almost every return. But that could be, the laws can be confusing on those. And also there's a lot of room for error, but also a lot of room for people deducting expenses they shouldn't be. So those are just two that come to mind quickly.
Yeah, I got you. So to kind of to clarify on that, you know, if you're selected at random, that's simply because you were selected at random to improve the IRS's ability to detect fraud in other returns. So basically, they're auditing you to either say, well, you either did commit a problem or you did not commit a problem. But it's basically so they can develop the gold standard of what your type of business should look like, so that they can use it for comparative purposes for the selection process of people that don't meet the gold standard.
Yeah.
Is that fair? Okay.
Yeah.
So then when we get into the diff score that you talked about, you know, like, again, the same client that I'm going to send this to, it's like, so I was like, I don't know, you know, our income is up, you know, by percentage, because they really made some good improvements. You know, like they busted their ass to improve their cost structure. Like, it's going to be a red flag. We're going to get audited because we made more money than the year prior. It's like, first off, I've never heard of that. But anyway, could you talk a little bit about like kind of the materiality of what the variance would be to kick out a diff score, you know, for somebody?
Yeah, I mean, it's hard to say because a lot of that's kept secret, but in terms of, you know, income going up or expenses increasing drastically, you know, I'm not sure of the variance. One thing I will mention is that anytime you are audited, the IRS is always going to look at your income, because if you've ever heard in the news, like we have a vast underreporter problem, you know, in the country, people just don't report all their income. So that is something that's going to be, you know, in every tax return audit. But in terms of how much of a change from prior year triggers an audit, it's hard to say. But I've always felt that, you know, if you're keeping good records and the numbers are what they are and you're entitled to that deduction, you shouldn't be afraid of claiming that deduction on your return, because if you have it properly documented and you keep good books and records, it's not going to be an issue if you're ever audited.
Yeah, so that's a great segue, Andrew, in terms of like, you know, walk us, you know, so what happens from our end is, you know, the client receives a letter from the IRS, you know, that basically says, you know, I'm your revenue agent. This is the appointment, you know, signed on this date, you know, or call me, you know, by this date. So that's when usually I get notified, you know, and I fill out a power of attorney so I can represent the person in front of the taxpayer. And then, you know, I contact you, and then you send over what's called an IDR, an information document request list of just the stuff that you're looking at, which is usually, you know, bank statements, credit card statements, you know, bank reconciliations, P&L balance sheet. You know, typically you want the accounting file, you know, that kind of stuff. Can you walk us through like what are you doing with that? Like, you get a bunch of information. What are you doing and what are you looking for in that?
Yeah, so I guess first of all, even before the letter is sent out to you, probably the IRS agent has spent 6 to 8 hours just like doing pre-work. So that's everything from looking at all the records in the IRS system to make sure you're current on filing all of your tax returns, pulling a background check, lots of other things. But then once you get the letter and we send out the information document request, like Adam just mentioned, there's a lot of different information. It's going to be all your books and records. It's going to be bank statements. And then more targeted support for those. They call them classified issues, but those are the line items that are being specifically audited during the examination. So what things like the bank statement, well, first of all, the books and records, the first thing the agent is going to do is going to try to tie them to the return, which basically means that the IRS agent is going to try to match up what's in the books and records and see how the return was prepared to get to the numbers on the return. And on most business returns, there's a reconciliation of that. So if that matches, then you're in good shape. But then we'll also look at the bank statements, and in every audit, we'll do what's known as a bank deposit analysis. So we'll add up all the deposits to the bank account and try to reconcile that to the income reported on the return. Because a lot of times if there's underreported income, you might have more deposits in your bank account. So that's a quick and easy way for the IRS to try to find unreported income. And then when it comes to actually auditing expenses that might be an issue in the tax return, the IRS agent is going to take, say, a sample of the source document. So say supplies is being audited and there's 100 different expenses that make up this large number. The IRS agent will probably pick a random sample of receipts and ask to see them. And then he'll look at them, and if that sample checks out, they're probably not going to look any further. So that's one of the reasons why it's extremely important to be organized in your record keeping, because if you make the IRS agent have to sort through a bunch of different books and records, or it's confusing, they might end up finding things that, or expanding the audit to things that you don't want them to. Whereas if you have everything organized out of the get-go, it makes the IRS agent's job a lot easier, which probably means he's going to spend less time looking at your return.
So we've got a question in, and here's the question. Are restated tax submissions submitted after the filing period subject to the same criteria for kick-out and subject to an audit?
Yeah, another way of saying that is, the other question we get asked quite often, Andrew, is, if I have to amend this tax return, is that going to be a red flag? Is that going to give me like 100% chance of being, literally, I get asked that, a lot. If I amend the return, I heard that I'm going to get audited.
Yeah, so the IRS, says that filing an amended return doesn't increase your chance for an audit. And when I was at the IRS, I remember looking at a few amended returns, but it's generally in the case where the taxpayer is claiming like a significant refund. So if it's not something where you're getting a large refund, I don't think it would increase your chances for audit. And even if, say, you're requesting a large refund, generally it's not a full-blown audit. The IRS might just want a little more supporting documentation just to see why you changed that on your return. So, if you're filing an amended return and you're entitled to the large deduction or credit you're claiming, I wouldn't worry about being audited, because even if the IRS requests more documentation, it generally doesn't develop into a full-blown examination where they're going to go over your entire books and records.
Cool. Another one we get asked a lot, Andrew, is, well, how long do I have to keep this stuff around? What's my risk window? Can you talk a little bit about the statute of limitations?
Yeah, of course. So the statute of limitations on a tax return is generally 3 years from the later of the date it was due or the date it was filed. So for example, this year, you're filing your 2021 tax return and you file it timely by April. It's April 18th this year because of Emancipation Day. But so April 18th, 2022, that means the IRS has 3 years. So April 18th, 2025 to audit your 2021 tax return. So that applies in most cases, 3 years. There are exceptions if you drastically underreported your income, or if you are committing fraud. So hopefully you're not in either of those two instances. And then if you never filed a tax return, the statute of limitations hasn't started running yet. So the IRS can go back forever for an unfiled tax return. And also, to mention about that, generally when a tax return is audited, there's still other years under statute So if the IRS agent finds an issue in 1 year, if there's a previous year that's still under statute or a subsequent year that's been filed, oftentimes the audit will be expanded to include those years. Because if you made a mistake in 1 year, it's likely you made a mistake in the other years as well.
Okay, two more questions for you here, Andrew.
Great.
One is what constitutes a significant refund? That's question one.
I mean, it's going to depend on the probably the size of the business. So what's significant for, a small business, isn't going to be as significant to, Bank of America here in Charlotte getting $1 million refund. That's, pocket change to them. So, it's going to depend on kind of your individual tax return, what's it looked like in previous years, what you normally pay in taxes, what your refund are. So it's hard to, say what's considered significant. It's more relative to your situation. But actually, if refunds are a certain size, they actually do have to be reviewed by this joint committee on taxation before they're issued. But those are generally multi-million-dollar refunds for large corporations. So that won't apply to many people listening.
Yeah. All right, cool. So the next question came in. For our business credit cards, if we are not keeping receipts for purchases, since they are obvious what they are, gas, meals, etc., are we at a lower risk of being audited if we always owe? Two questions here. Sorry. For our business credit cards, what if we're not keeping receipts for purchases since they're obvious, like gas, meals, travel, etc.? So that's the first question.
Yeah, so the IRS generally will accept credit card statements, but it doesn't give as much detail. So if there's questions, they're actually going to want to look at the receipt. So I generally think it's a best practice to keep the receipt if you can, especially for things like meals and entertainment. Generally, if you're not keeping the receipt, you should at least keep track of what the purpose of the meal was, because there is a lot of times people, are deducting meals they shouldn't be deducting. They might not be out of town. They might not be truly entertaining a client or something like that. So best practice would be keep the receipt, but you don't necessarily have to, is the short answer.
Okay, thank you. Next question is, are we at lower risk of being audited if we always owe the IRS and never get a refund?
Not necessarily, because the IRS isn't really looking at the amount you owed or that you were refunded. They're really looking at the comparison of the actual income and expenses. So just because you owed money doesn't mean you shouldn't have owed more money. So the IRS won't really look at that, because if that were true, then people could just way overpay their taxes and never be at risk of an audit. So the IRS has kind of figured that out, and it's based on your actual income and expenses and not on what you owe or get refunded.
All right, so I'm going to keep him anonymous, but he's one of our favorite fractional CFOs. Here's this question. He always has good questions. Is there a higher risk of audit if payroll tax payments are not being made? And are the risks of this greater than just not paying income taxes?
I would say so. So I've never done, payroll tax audits are handled by a separate area of the IRS, but I would say if the taxpayer isn't in compliance, that there's definitely a higher risk, because, the IRS knows if a payroll tax return should be made, and if it's not, they'll eventually catch up to you generally. Or even if they don't audit the payroll tax returns, if they start an income tax return, they're going to look to see if you filed all your payroll tax returns. And if not, then it will be expanded. So yes, if a tax return is required to be filed, I would definitely file it.
And Gary, let me share a perspective that an IRS agent shared with me when I was helping a client through a payroll issue. When the simple explanation was, hey, employer, you are an agent of the IRS, and he actually meant trustee. So you're a trustee of the IRS. You are collecting money from your employees on behalf of the federal government, and you're supposed to pay it to the federal government. And where the problem occurs is, well, step two doesn't happen. And it's, oh, well, I need to borrow a little bit from that money from that fund to pay an expense. And then it, just snowballs into not paying that money that doesn't belong to you. Similar to, our firm's trust account. It's money that we have from a client that doesn't belong to us. It's always their money until we earn it. And then we do put it into a separate trust account, and there is a physical movement of funds from a trust account to an operating account. So similar concept is that you as an employer are a trustee, a fiduciary for the federal government. And so you basically have stolen money in the IRS's view. At least that's my understanding. Andrew, I don't know if that is accurate or maybe overstated.
Yeah, no, I completely agree with that. There's the penalties for basically taking the employee's tax payments that should have been paid to the IRS and not paying them are much larger than most income tax penalties. They're called trust fund penalties, and you definitely don't want to get into that situation because they're massive penalties and there's major issues just for the reasons Jack said. You're like trusted as a fiduciary of the IRS to remit the employee's money to the IRS because they're going to be counting on those Social Security payments they paid in to be there when they retire.
Okay, so we need a story from you, Andrew. So what I want you to think about, and Rebecca, her chat was, don't press the red button. I did press it, weapons drawn. I'm sure that she'll never forget that. But what I want to know is, like, give us a story or two of some of the most memorable, like, whoa, I can't believe that happened, or the craziest things that you've seen as an IRS agent.
Yeah, so one that comes to mind is, so they're known as tax protesters, but basically people, you've probably heard these people possibly on the news saying like, oh, the income tax is illegal or unconstitutional. So I once was auditing this lady who was actually, I think, running a home daycare or something like that. But she had filed a strange tax return. And there's this theory out there that's called the straw man theory. And basically, people believe, so back when the US went off the gold standard, I think it was Eisenhower, they claimed that the Eisenhower pledged the US citizens as collateral for our now unsecured fiat money. And if you file a tax return a specific way, there's actually an account in your name at the Federal Reserve. And if you just file this tax return a special way, you'll get a refund of tens of thousands of dollars because you're getting what's owed to you. So a woman told me she did this with a straight face. I mean, she had found a tax preparer who did it for her, but yeah, when I was hearing that, I almost couldn't believe it. And I had to call in the IRS criminal investigation, and they had an interview with her. And ultimately, they weren't as concerned about her as with the preparer who probably sold this, fraudulent argument to her. But that was one really memorable experience because there's lots of pretty wild beliefs people have about the legality or illegality of taxes. Another one that comes to mind, so I talked about how I got to audit a wide variety of businesses, and I also audited a decent amount of farms. So this was back when I lived in Cincinnati, Ohio. So I was working at the Cincinnati office, and I'd oftentimes go into Kentucky to audit these farmers. And I was actually auditing a tobacco farm, but I show up and basically it was the most unique circumstances. So as a revenue agent, I generally go to people's place of business, but these people were just basically living in a trailer on the property. And I, show up and sit down in their sofa, and they're chain smoking the entire time, and dogs are running around, and there's CSI Miami on the big screen television, and you have to contend with all sorts of distractions when you're trying to do an IRS audit. But that was definitely probably the most unique situation I ever had to talk with someone about their taxes. And so.
Oh, man. Yeah. Complete with junkyard dogs and everything. That would be
Yeah.
crazy.
Fortunately, the dog was nice. Didn't try to attack me or anything, but
Oh, that's good. Oh, man. So Robert chimed in. Nixon took us off the gold standard for anybody wondering. So thank you for
perfect.
that.
Yes. Yeah.
So, all right. So this is a non-IRS question. So this is really probably going to go to Jack or, well, any one of you. It's a free for all. Whoever wants to do it, just don't hit the red button. All right. So here's the question and scenario. Thanks, Greg. I talked with him earlier and I said, be on this and we'll answer your question. So Greg is a business broker and he has a client that's selling his portion of the company to his partner. The company has an EIDL loan with both partners' name on the loan. Can the selling partner have his name removed from the loan? And if so, what's the process?
Yeah, so we've had this come up a couple times, and Jack, you may have had this on some closings. If you haven't, you may have them coming up, but you basically have to go to the SBA and have them removed as a guarantor on the note, which it's just a process. Your other meaning, you read like if you go to the SBA website, there's a way that you can contact them. I don't remember what it is off the top of my head, but we've had a client that has had to go through this with an internal buyout. I think option B is we've had we're now at the point where we had told a lot of clients that there's high likelihood that when you refinance your debt, there's a chance that the bank will want to take out the EIDL loan because they don't like being in second position to it. So the other route that you would go in this particular case would be if part of the transaction is associated with bank financing, it could be that the bank just takes on the EIDL note or requests to take on the EIDL note as well. So if it's an internal buyout, seller financed or all cash, you got to go to the SBA. If it's an external bank may refinance it.
Yeah, and I would say that there are some unsecured EIDL loans out there, and I can't remember, for some reason I'm thinking maybe 200,000 is maybe the level. But you think about it kind of in traditional aspects of when the bank or a landlord or someone else who is a creditor has their claws into the business assets and personal assets of its owners. It is usually many times difficult to have that lender remove those clause. And so, what might happen is, for example, as Adam said, maybe a refinance to kick out the EIDL loan. There's also, as he said, going to the lender and asking for, what can we, is there enough collateral when this person is removed from the security interests arena of collateral that the lender feels sufficiently collateralized. And so it may be that the lender says, well, we're going to keep them on the hook, but let me suggest this to you, business partners. Why don't you have an indemnity agreement between the two of them, or a contribution agreement that says, hey, if we get hit, then you have to contribute. It could be that whatever. What I'm saying is that it may be that the lender, the SBA, says deal with it amongst yourselves as to how you want to deal with a potential issue, but we're not going to let you off the hook. So it's a matter of usually in most cases an analysis of, do they feel sufficiently collateralized with letting the one owner go? But that's the case in kind of generally all type of lender, borrower, debtor, creditor situations with respect to guarantees in the first instance.
So Andrew, I got another question for you. We have a number of clients that buy and sell businesses, pretty frequently. And I've got one friend in particular that had sold his company for, I don't know, it was probably $80 million, something like that. It was pretty significant. And sure enough, boy, they got audited lickety split the next year, once that hit. What is that percentage, or do you see a higher likelihood when somebody has a big liquidity event for an audit, or was that just an anomaly, do you think?
Yeah, it may have just been an anomaly. I'm thinking about back to my time at the IRS, and I really didn't deal with too many, audits involving, a previous transaction, a recent one. So that all goes into, that diff score I talked about earlier. I don't know the audit rates of people who, sold their business. It was likely, it's hard to say why they were audited, but I don't know of anything that, would cause a business that was just purchased or sold to be, kicked out for audit.
Have you seen anything like that, Adam, in your experience, or even Jack from, client selling?
No, the two most common misconceptions that I have is that, if I sell a business, if the disclosure form or the treatment method doesn't agree, does that mean I'm going to have a 100% likelihood of an audit? And the answer to that is, typically I haven't had that happen, but at the same time, we try to get the purchase price allocation correct and agreed upon anyway. So it hasn't really been an issue that I've had to deal with, because we try to make sure they're correct. But even independent of that, the risk in a transaction, really is the buyer risk, because they're trying to get away with getting a deduction in the current year that really should be a Section 197 intangible property. It's not a seller risk, because worst case scenario is you can't deduct the expense of paying the guy in the current year's consulting agreement. It really is goodwill. It's capital gain, amortizable over 15 years. Super. Well, the buyer just made more money because now they get capital gain treatment on the transaction instead of ordinary income treatment on it. So it really is a buyer risk if you're trying to be aggressive on the transaction side, for the most part, based on what I've seen. A lot of times, I love Jack and Andrew, but I'll get a whole lot of, IRS red flag if we don't allocate at least 15-20% of this transaction to a non-compete agreement. Like, I've never freaking heard of that. So maybe Andrew could weigh in on that, but I've never heard of that.
I haven't heard of anything like that when I was at the IRS either. I think there are a lot of misconceptions, probably somewhere along the way, maybe someone was told that once, and then people think it's a general standard of law. But one thing I did think about related to the sale of the business. So we talked about previously the statute of limitations, 3 years. After that, you don't have to worry about being audited. And generally, there's lots of recommendations for how long you should keep records for. We generally recommend a few years past 3 years, just in case. But you should generally always keep copies of your tax returns. And also, you might not have thought about this, but copies of your W-2s as well if you're an employee, because occasionally the Social Security office makes mistakes in how much you've paid into Social Security. Actually, my manager at the IRS, her husband actually had this issue where they said he paid in less than he actually did. But fortunately, he was able to get copies of his past W-2s and rectify the situation. So that's something else. And also, you should also keep records that have to do with a deduction you might take in a future year. So say records related to depreciation or basis of an asset you purchased. Even though you may have purchased it 10 or 20 years ago, you still need to keep that record for when you eventually sell the asset to be able to prove the basis. So just keep in mind.
I have told people that one rumor that is true is that if you can't prove your basis, it's going to be assumed that it's zero. Unless you've got a way to kind of back into it based on some other publicly available piece of information. I see Gary's going to ask you a question in the chat, but I wanted to go one more question that I hear all the time as a red flag. I actually heard this from an attorney as well, that I'm like, never heard of that one either. And everybody I've talked to never had that happen. And if it's not your subject matter area of expertise, Andrew, I totally understand it. But gift tax returns, man, if you're doing a gift and you got a discount in that gift, 100% chance that's getting audited.
Yeah, I don't know. So that's not really my area of expertise, because there's actually a separate area of the IRS that does gifts and trusts, basically. So I wouldn't have seen any of that. So it's hard for me to say whether a discount would affect the audit.
Okay. All I can say is I've done a lot of them and zero have been audited.
Yeah, okay,
so it's like, I can't say it's 100% because I've had zero. So maybe somebody else is at 200%.
Yeah, maybe.
So we're at an average.
All right.
Related
so-
to the dollar amount too, right? I mean, is it worth
Yeah.
the while to jump into that mix? So
Yeah, it is. Yeah, so that's a good point. IRS agents do look at that. Generally, the IRS wants you to keep agents to spend about 30 hours or less per tax year they're auditing. So that's not a whole lot of time if you spend 8 hours before you go out and meet with someone, and then another day or two there and typing up the report. So IRS agents definitely do sort of an 80-20 analysis, being like, is there any money here? And if not, the government's time is better spent auditing someone where they're going to get tax out of them.
Next question is, I've heard that there's a greater chance of being audited by the IRS when the tax return is filed by its first due date instead, and less risk when it's extended. Is that true?
I don't think that's true. I audited returns all the time that were filed on extended due dates. It's just how it comes out. It goes through the same algorithm. There's no, preference or adjustment, I believe they make for, whether it's filed by the first deadline or the extended deadline. To the IRS, it's all the same. Although I will say that oftentimes people that file extensions, I came across, it could be because they're more disorganized people in general and have issues with their records. So that might be why, returns that are filed by the extended deadline, maybe why I saw more audits of those. But there's plenty of legitimate reasons for filing an extension, and I don't think it really affects the audit determination.
Okay, well, we can count on Robert to ask the crystal ball question. So you are on tape, you are being recorded. It will be on the BGW CPA YouTube channel. So keep that in mind, whoever answers this question. So the question is, will Social Security be there when we retire? And if they run out of money, can we sue to get our deposits back? That's sounds like an attorney question to me.
Yeah, I'll be right there with you if, there's no Social Security for me and I've paid him this money. Although, Jack probably would feel the hurt more since he's further along than I am. So
I've taken the perspective that I am respecting my elders and basically kind of helping them out just because they came first in evolution. So yeah, it's like if it's there, it's there, and that'd be great. But not definitely a big part of my financial planning aspects for my retirement days.
Yeah, it's funny. I used to say, 10, 15 years ago when I was talking to my dad, this is all your fault. It's like, you guys took over the government, you ran up all this freaking debt. There was too many of you, you wouldn't make any hard decisions. And now you left me with a, bad environment, bad federal debt, blah, blah, blah. Well, now I am my dad. So it is my generation who's currently in charge. So it's like, well, I don't know what we're going to do now. Besides,
the progressive.
You're going to have to fix all my messes and all my dad's messes.
The Progressive insurance commercials are spot on. You become your dad.
Yeah, that's right.
So Andrew, look at Jack. Look at what you got to look forward to. I'm just saying.
Okay. Yeah.
Thinning, receding, gray, all that.
These are good questions. Hit us up with some more, man.
Yeah, the other, another thing I could talk about. So we haven't really talked about what happens at the end of an IRS audit. So basically, after the IRS agent has looked at all your books and records, they will issue a report, and it can either be no change, you owe money, or you're due a refund. And when it comes to that, you as the taxpayer can either agree with the agent's findings or not agree with them. And it's a lot easier to fix things at the agent level because the agent is kind of the first line. So if you can come up, with a resolution that works, that's the best way. There are avenues to appeal. So generally, after the agent, you might have a conference with their manager, but generally agents and managers generally tend to follow tax law pretty closely, generally apply the letter of the law, although there is some leeway. But after that, if you still can't come to an agreement, there is IRS appeals, which is similar to mediation, where they're actually taking into consideration kind of the hazards of litigation, how much money is the government going to spend, what are the likelihoods of the government winning a case if it goes to tax court. So a lot of cases get settled in IRS appeals as well. But then if you can't settle it there, that's when your opportunity is to go to tax court, or you can also file a claim in district court as well. But so there's lots of avenues that how it goes throughout the process. But like I said, it's easiest to get it resolved at the lowest level with the agent because it will cost you the less amount of time and money because you have to pay your accountants and attorneys, even more as we continue up the ladder of appeals. So
Yeah, I think kind of a follow-up with that. I'm going to get probably the verbiage wrong, but generally speaking, tell me if I'm right or if I'm not right. If it's a gray area where legislative intent is unclear and law is unclear, then the tax courts generally side with the taxpayer instead of the IRS. Is that generally a fair statement?
I think that sounds about right. It's hard, seems to be what they do, but again, sometimes there's IRS, tax court decisions that go against that. But one, an example I have, also a lot of tax issues are very fact specific. So for example, one of the issues I saw a lot of were hobby loss issues. So it's individuals that have a regular income but decide to have a farm, breed horses, or have some other small business on the side that gives off losses. A lot of times the IRS will challenge this and say it's a hobby rather than a business, and tax law provides that you can't deduct losses from a hobby. So a lot of times as IRS agents, we would say it's a hobby, disallow all the losses, but then it would get up to IRS appeals, and IRS appeals would basically reverse what we did, which, annoyed a lot of agents. But what I didn't really appreciate at the time is that, appeals is looking at this going to tax court and saying like, yeah, I could actually see the tax court ruling for the taxpayers. So it's better to sell this now rather than waste everyone's time and money. So definitely don't be afraid of appealing if it's an issue like that, where it could come down either way, because it's likely someone higher up the line is going to be more sympathetic to your position than just the revenue agent or their manager applying the letter of the law.
All right, two more questions. One is, how effective are tax relief agencies like an Optima, et cetera? So think about that. And secondly, in a recent webinar, you discussed some of the guidelines for determining 1099 versus W-2 status of an employee. Could we also get Andrew to comment? And does changing an employee's status raise a red flag?
Yeah, so I'll give my opinion on the Optima. They're really effective at taking your money for a deposit and then not resolving anything for you. My own opinion on that, and I will let Andrew opine, but you know, in general, when the IRS finds that you owe money and you need to pay them, like unless you're in imminent, like unless you have an imminent disability or catastrophic something or other with no ability to earn any income ever again, you're not going to get out of shit. And it's not, I mean, this would be more of a legal question. These items are not dischargeable in bankruptcy either. So, Andrew, what say you and Jack on that one?
Yeah, no, I agree. Yeah, taxes are the one thing that's always going to stay with you. And we always see those commercials on TV or whatever saying like, oh, they saved me tens of thousands in taxes. But oftentimes, I think these taxpayers probably didn't, respond to the IRS when they first got the letter. And then what happens if the IRS doesn't hear from you is we just assume whatever we're auditing is incorrect on your return and we'll assess the maximum amount of tax possible. So those tax savings probably aren't realistic because if those taxpayers, made timely contact with the IRS, it never would have gone to that large of a bill. But this also brings to mind that it's important to get, your CPAs and attorneys involved like right away if you get a tax notice in the mail, because like I mentioned, it's a lot easier to resolve things and a lot less costly at the initial stages rather than if they've gone on for a while. And to the employee 1099 W-2 issue, I don't know if changing status would be a red flag, but I will tell you is that employee classification is looked at on returns, especially if you're paying a lot of people as 1099s when they should be employees. So the IRS is aware of that issue, and it does come up a lot of times in audits. And what happens is that then an employee classification separate audit, because it's handled by a separate area of the IRS, does get opened fairly frequently. So employee classification is definitely on the IRS's radar and something you should make sure you're doing correctly.
All right, another question for you, Andrew. Is it possible to negotiate away the penalty and or interest with the IRS?
Yeah, good question. So generally, I've never seen interest waived. That's just kind of the IRS's position. You should have paid the tax then. This is just standard interest, kind of, we gave you a loan and you got to pay the interest back. In terms of penalties, there is room for negotiation. So generally, when I was an IRS agent, I would always almost assess a 20%, it's called a negligence penalty, which really you can almost assess against anyone that owes taxes because it's saying, oh, you should have known better than to deduct these, erroneous expenses or underreport your income, et cetera. So I would always assess it. Oftentimes people would pay it, but I would get pushback. And oftentimes if you agree to pay the tax, but say like, hey, can we get these penalties waived? A lot of times the IRS is amenable to that because they're going to get the tax owed and, it doesn't have to go on to higher levels. So short answer is yes, you can oftentimes get the penalties waived if you have good arguments. I've never seen interest waived.
Andrew, would you also maybe explain as kind of a extension of that question, the offer and compromise situation, which I kind of view as a confession of judgment, essentially, and it's a settlement, and then if you don't comply with the settlement, then there are consequences. So maybe you can kind of touch on that for a moment.
Yeah, so strangely enough, I never really, when I was working at the IRS, was involved in an offer and compromise, but basically it's kind of like a settlement between you and the IRS where you oftentimes say like, hey, this is how much I can pay or how much I can owe. They will look into your finances pretty detailed and deeply. And then you have to then, if you come to an agreement, you then have to comply with whatever the stipulations are, paying these payments on a timely basis and anything else. So, it's possible to do offer and compromise. A lot of times there's a lot of restrictions to qualifying for it. So it doesn't always, many people aren't eligible for them, but it's always an option to look into, if you're audited and you're finding yourself with the tax bill.
Andrew, you have done a fantastic job in the confessional booth today.
Great.
It's really been good to have you on here, man. Really good questions. We've got just a couple more minutes. So anybody that's, you can remain anonymous, even though sometimes we know who you are. We've been trying to be really careful, keep your anonymity. So if we didn't deal with a question that's burning in your mind, raise it now. And again, anybody that came on late, if you missed the front end of this thing, we will put it up on the BGWCPA YouTube channel later on this afternoon so that you can send it to your friends and neighbors and all the conspiracy theorists. I had one guy that was just railing on me after one of our webinar promotions, if you will, on taxes and whatever. And he was basically saying, I was a fool for not believing his conspiracy theory of like what you were talking about. And, that, I'm part of the problem because, I'm not subscribing to this crazy, tinfoil hat stuff. Like, it is crazy.
Yeah, what's funny, there's actually an IRS webpage where they list like the top 20 frivolous arguments they hear, and they're pretty, if you're ever looking for a good chuckle, definitely, Google that and read that because it's amazing the arguments people come up with. One other thing I can talk about is that, so the IRS oftentimes can get third-party information very easily. So sometimes people say, oh, I don't want to turn over my bank statements or things like that. But the IRS basically says, no problem, we'll just summons it from the bank. And that's not an issue. I filled out administrative summonses all the time as an IRS agent, and the bank would just turn over the documents. So definitely it's much better to, comply and give the information the IRS requested because they're going to get it somehow. I mean, they're the government, they have deeper pockets than you. So just another point I thought of.
All right. Another serious question. Can you speak to IRS 179 business vehicle deduction?
Yeah, I mean, that's probably a better question for Adam since he's a little more up to date on the.
Yeah, maybe you could hit on, where it would come up in an audit, but the 179 expense deduction, I mean, where it's never going to be a problem is when it makes sense, like, it truly is a work truck, or even an SUV that looks like it clearly be a work SUV. Where it's been a problem in the past, or at least I would say, good likelihood it's going to be a problem, would be when you're trying to make the case that the Porsche Cayenne is a delivery vehicle. so I hope that answers your question, Chris. But I mean, where I see it being more of a problem, but you still got depreciation expense for the Porsche Cayenne, scenario, assuming that it still meets the business purpose intent. Where I see it being more of a problem is when I'm trying, when Section 1, it's not really a problem right now because bonus depreciation and Section 179 are effectively one and the same. So it's really been a problem when they weren't, one and the same. But it really is when I'm trying to fit, something that shouldn't fit into the square box of 179, which really comes down to kind of vehicle class and attributes.
Yeah, and on IRS audits, when this would come up, depreciation is definitely an issue that's looked at. Most of the time when there's an issue with depreciation, it's a lot of times kind of what Adam went to, where either the vehicle doesn't really qualify for the business purpose, or the business people claim the business purpose of the vehicle is 100% when it's actually 50% or less. So that's really when it could come up in an audit. And I did do some depreciation adjustments in my time.
Yeah, the other thing they were looking for too, it's kind of unrelated to 179, but it comes up with vehicle expense. I also just want to make sure that you're not double dipping, like, hey, I depreciated the expense and oh, by the way, I was also submitting mileage reimbursements.
Right, yes, exactly.
That actually happens more commonly than you would think.
Yeah, that's probably why car and truck expenses are audited so frequently, is because there's the two different methods for deducting expenses. And it's also confusing. The IRS, wants you to keep a mileage log and a lot of different things like that. So lots of record keeping, and oftentimes people make mistakes.
So I know we're at the noon hour, but I have a quick question that I just thought of that clients have asked in the past is, and this may be myth or maybe reality, is that in an effort to be efficient, that the IRS goes after certain industries and focuses on, let's say, landscapers, then restaurants, and then others. Is there any truth to that?
There might be some truth. I don't know if they audit it, target industry specifically. There could be some of that if they find issues in certain areas. But what you can actually find on the IRS website, they're called audit technique guides, and they're actually on specific industries. So the IRS has basically told its agents, when you're auditing something in this industry, so there's everything from cash intensive businesses, such as like barbershops and things like that, to manufacturing, to the timber industry, all have a special guide. So if you're involved in an audit and are in a specific industry like that, it's a good idea to look at those audit technique guides. They're available to the public, and they will actually tell you what the IRS agent is probably going to be looking at, and also how you should be keeping your books and records. So I think occasionally the IRS does do projects on specific industries, but they don't really make that known. And I never really saw any when I was at the IRS. Another interesting thing is that the IRS does look into whistleblower complaints. There is a form you can file if you think someone is fraudulently doing something with their taxes. And those would actually come to our office, and people would look into those, and they resulted in audits and in money owed to the IRS. For example, I remember one, I didn't do this audit myself, it was another agent, but someone at a church filed a whistleblower report claiming that their pastor was embezzling from the church. And for example, we looked into it and he owed a lot of money. But so I guess if you think someone is being shady with their tax dollars and really want to get back at them, file a whistleblower complaint.
Or
Man,
some
this has been
adversarial
good.
ex-spouses, maybe?
Yeah.
Adversarial ex-spouses, yeah.
Yeah, things like that.
Oh, yeah, that's weaponizing it. Gosh. Oh, all right. So you'll appreciate this, Jack, and you may want to take a cue for this for next week. I'm just telling you. But Tim says, in the spirit of Jack's dad jokes, and Andrew, if you haven't been paying attention, like he's really got a bunch of bad ones. So, you might want to break the chain right there, on the, but here's the deal from Tim. 2 silkworms got in a race and it ended in a tie.
Oh,
I like that one. See, you guys are smiling. It's
You would.
polite laughter. It's polite laughter. Yes. Now, I've not subjected Andrew to that because I do want him to still come down the hall and come into my office without fear. So I don't, although I might now, as soon as you come in the door, have him ready. So.
All right. Final question. Is there a reward for reporting somebody?
I believe there is, but I'm not sure if it exists in every circumstances. I do remember there were some big cases back maybe 5 or 10 years ago when there was the whole foreign bank account issues, and a whistleblower from UBS got, I think, millions of dollars from the IRS. I don't know the laws surrounding the rewards. I know they exist in some instances, but whether they apply in every situation, I don't know off the top of my head.
What a great discussion today, man. Good questions, fun. Good to have 2 people from Shoemaker on here to balance us out from 2 people from BGW. So really good stuff. We are 5 minutes past the time. So we're going to go ahead and sign off. Somebody's just, hold on. Marguerite. I've noticed when Googling information related to payroll taxes, reminders regarding the information will come up when paying the taxes. That's weird. Does it matter?
I guess I'm not exactly sure what she's referring to. Do you know? Either of you, Adam or Jack?
Yeah, no, but now I'm going to Google it and find out what happened. So hopefully our IT guys don't, put me in prison.
Big Brother.
That's right.
It's all about Big Brother. That's why I don't have Alexa in my house. I don't care. I don't. So anyway, good. Wow. Another good question. All right. Well, be careful what you Google. So, all right. We're signing off. Have a great week. We will be back on the same Bat channel next week. And the topic will be yet to be disclosed, but I think we're going to actually probably release a little video that from our 100th week anniversary next week, just as part of the promo. So stay tuned for that. Thank you for taking time out of your busy day to join us. Thank you again, Andrew. Thank you, Jack. Thank you, Adam.
All right. See you guys.
It's a wrap.
All right.
Thank you.
Bye-bye.
Thank you. All right.